Well, I mean, short version means a lot of uncertainty. So Israel launched a series of airstrikes, are probably going to continue for the next few days, and I think there are a couple things to watch and see, whether the situation is going to escalate. I think we're waiting to see if there are going to be these discussions regarding Iran's nuclear capabilities, which presumably have now been diminished as a result of some of these airstrikes on Sunday. And does Iran sort of wait until after those talks to have a more aggressive response? They sent over about 100 drones or so. Most of them were shot down. And I think that's sort of the thing to keep an eye on is what is Iran's response going to be?
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice because it's not. Here we go.
All right, welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is Friday the 13th of June, 2025. I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
As a reminder, all the charts we reference are posted to our Twitter and LinkedIn accounts. If you want more of what you hear and invest your own assets, become a RenMac Access subscriber at renmacaccess.com. If you're on the institutional side of the business and not already a client, then we encourage you to reach out to sales@renmac.com for more information on how we can help you navigate the markets. So not sure we're going to be able to get through everything in 30 minutes. There's a lot going on. I obviously want to talk about the employment picture in the Fed. We have the China trade talks, comments on where real rates are, the dollar, the term premium, movement in the metals market, more focus on beta and momentum. We had a couple eagles yesterday out at the U.S. Open, a double eagle. So we can talk about that too, Jeff. You got anybody you like in the U.S. Open?
I honestly forgot it was even on.
You're focused on Father's Day?
I was so disappointed in my game at the member guest last week, which is why I wasn't here. I'm done. It's like my golf game is done. It's June, whatever, 13th. I'm done. It's all over. Next year. There's always 2026.
Stick your sticks on Facebook Marketplace. See what you can get.
At least you're talking about golf, because the rest of that stuff sounds like a total snore fest.
Well, this isn't.
You just lost half the audience right there. That's a real rate.
That's my job, to lose the audience. I'll be out of this one in no time. I think we got to start with Israel and Iran, right? And more broadly, the Middle East. So, Steve, let's turn it to you. I know it's Friday morning, so things will change as we go. But where are we now? What it means, and what your thoughts are?
Well, I mean, short version means a lot of uncertainty. So Israel launched a series of airstrikes, are probably going to continue for the next few days, and I think there are a couple things to watch and see, whether the situation is going to escalate. I think we're waiting to see if there are going to be these discussions regarding Iran's nuclear capabilities, which presumably have now been diminished as a result of some of these airstrikes on Sunday. And does Iran sort of wait until after those talks to have a more aggressive response? They sent over about 100 drones or so. Most of them were shot down. And I think that's sort of the thing to keep an eye on is what is Iran's response going to be? And right now, Iran is blaming both Israel and the U.S. for this. The U.S. is denying involvement. I think that's sort of the worst case scenario. The worst case scenario is that the U.S. is drawn into this conflict because Iran has sort of struck some sort of U.S. interest. And then I think maybe the best case scenario is, Iran decides to have these talks on Sunday, look for that diplomatic off-ramp, and probably end up somewhere in between. But that's sort of how I'm thinking about it.
Neil, does have
any... a protester in the backdrop.
That's smart. Somebody's not allowed to go to the dinosaur museum.
Oh, man, I'm surprised that's not you. You might have an airstrike on you here pretty soon. Those are fighting words.
He uses a different chemical weapon, but I'll see.
Neil, does that have an impact on the China trade talks at all? I mean, you had this comment out this week about the Tariff Derangement Syndrome. But what are your thoughts on what's going on there and the implications going forward?
You mean with respect to what's going on in the Middle East?
Yeah, just whether or not that impacts our ability to negotiate with China.
Well, I have no idea about what it means for China. I mean, I that's sort of beyond my pay grade. But I think it's important to remember, like, the work of Ben Bernanke from the late '90s when he talked about, the effect of oil prices on monetary policy. Right. I'll quote from the paper. Our results suggest that an important part of the effect of oil price shocks on the economy results not from the change in oil prices per se, but from the resulting tightening of monetary policy. That finding may help explain the apparently large effects of oil price changes found, by other economists. So, the risk isn't so much oil prices. The risk is what the Fed's doing in response to oil prices. And so if you think the rise in oil prices today will just reinforce the Fed's go slow approach to rate cuts, that could be a potential problem, I think, for the economy. If they're focusing on things like inflation expectations and the potential run up in headline inflation because of what is seemingly a negative supply shock because of these geopolitical tensions, then that could be a problem. So, it's something we're keeping an eye on. It's obviously geopolitical. So as quickly as the run up in oil prices happened, it could come crashing back down. I mean, certainly oil prices were somewhat lower, in the weeks and months preceding what we just saw this week. But it's something we're keeping in mind. Yeah.
Jeff, your thoughts around the dollar? I know it had its the lowest low since 2022 recently. Did that change? Do we see a rush into the dollar? What are your thoughts?
Well, you would think, particularly given what we've seen in with this overnight, military action, you would think that there'd be a flock to the safe haven and not so much the dollar. I mean, obviously there's part of that, but you're really not seeing it in treasuries, right? So you're not seeing that traditional sort of safety trade. Look, there's something going on there because we've got high real rates. Real rates are in the top 80th percentile if you look at it on a kind of rolling 3-year, 5-year Z-score, and real rates generally attract capital, and that's just not happening, right? It's not happening in the treasury market. It's not happening through the dollar. There's something afoot here, and usually that's not good news. High real rates are not good news for equity prices, particularly long duration assets, because they're competing right with those assets. So, I think that's something we have to keep an eye on. Now, the good news is, from a technical perspective, the hat that I normally wear, things are actually still in pretty good shape. So I'm comforted by that. The market is clearly seeing this and still able to move forward and thrive, frankly, and that is happening globally. But there is a disconnect. Something is different today than anything that we've seen in the last 20 years in terms of these high real rates not having the same impact that they do on other assets. And I think part of that is probably the yen carry trade and that unwind. But there are definitely some cross currents here that it's just not clear what that message is as we go. And it's going to be really important for us and what we do every day to follow that and just to kind of see where that path takes us. What kind of breaks here, because there are two divergent paths that probably don't have long-term sustainability, and something will give. So that's really what we're paying attention to here.
So, Neil, does that mean the Fed's behind the curve? I mean, the employment picture doesn't look that good.
Well, yeah. I mean, speaking of conditions that may not be able to last. I mean, we all remember the great quote from Herb Stein, noted economist. If something can't go on forever, eventually it will stop. Well, one of the things that we've noticed lately is just we're running at basically cycle highs in continuing jobless claims. Okay. And that basically tells you that the well of unemployment is going up, right? So even though initial claims have more or less been steady, continuing claims have kept going up to cycle highs. That's because the hiring rate is really low and it's getting really challenging for people to find work. So every time you get some newly unemployed person, newly laid off person, they can't find work, so they just stay unemployed. And that's how the level of unemployment continues to rise. I think the risk is that this is really the beginning of something more onerous, because I do think that initial layoffs will probably go up. You're seeing a lot of anecdotal evidence around that, whether it's Procter & Gamble, whether it's Microsoft, Paramount, Disney. You kind of go down the list. It's wide-ranging across industries. You're seeing, layoff announcements. So that being said, one of the relationships I think is interesting is just stocks are rising, claims are rising. Now, obviously, that is unusual. Historically, you want to see stock prices go up and claims go down. That's not what's going on. So to me, now obviously, when this started, we were coming from very, very low levels. It was really a normalization of what was going on in the labor market. But, at some level, you would expect there to be an inverse relationship. I mean, historically, if you look at it, there's it's an inverse relationship between the two series, right? Stock prices tend to go up in an economic expansion, and jobless claims tend to go down in an economic expansion. And right now, they're both going up. So what's normally an inverse relationship is going positive. And I just asked the question, like, how long do we think that that's going to sustain? Particularly because, you asked me whether I think the Fed is behind the curve. I do. I think they're telling you they want to be behind the curve because, they're saying, they're kind of on hold because of, policy changes and uncertainty, and they feel like their policy is well positioned. But, in the process, I think they've misjudged the economy as it is. And that means that they continue to passively tighten monetary policy. So to the extent they continue to wait, they're wading into an environment where nominal growth is probably slowing down. And so that, just reinforces the slowing, right? So typically I think of the Fed as like short-circuiting these negative feedback loops, and right now they don't really want to. So that just means that the negative feedback loop will continue. So it's been interesting to see equities go up. I think a lot of that has to do with AI. But at any rate, I mean, it's just an observation. Continuing claims are at cycle highs. The stock market is basically at highs. How long do we think that'll last? Because at some point, it can't.
Well, I think it's the expectation, Neil, that those claims are going to start to weigh on the Fed and force them to cut, right? So that's the market kind of thinking 2 chess moves ahead, that the claims actually end up being good news, because that will give us the monetary thrust, if you will, from the Fed to lower that short-term.
But the bond market's not saying that. Right, that's the. I mean, maybe equity investors are saying that, but the bond market is basically consistent with the Fed's dots. It's not saying the Fed's going to do any more. So the stock market, to the extent that it's keying off expectations of the Fed haven't really changed all that much. I mean, we were kind of at 2 cuts. We're still at 2 cuts. This isn't like a few months ago when we were close to pricing in 4. So that's not what's going on. So if equity market investors are saying that, that's not exactly what the bond market is telling you. So, it could be, but I frankly, to me, I think it's sort of, people have been betting on recession for so many years now, right? I mean, it was a bet in 2022, 2023, 2024, and they're just getting tired of betting on it. And so that, to me, just raises the threshold of what you need to see before you kind of ring the alarm bell, right? And so, look, by Powell's own admission, he was a little bit behind when he cut 50 in September. What does that make him now? So I do think that there's, and I also, again, this is more your lane than mine, but I mean, I don't know that the stock market's really discounting anything. I think the stock market's reacting to whatever Trump is saying in many cases. We had the big drop in equities basically after he threw up a slapped together Excel spreadsheet on a big poster board around reciprocal tariff rates, and that's why the stock market went down. So was the stock market discounting that, or was it just reacting to it? And since then, it's been, we're doing a deal with China. We're doing a deal well, this week was London. We basically, the deal in London was basically meant to redo the deal in Geneva. So we did a deal to go back to the deal we struck in Geneva. We're getting close with India. We're getting close with Japan, and the market seems to like that. But in the background, we haven't really seen an adjustment in earnings expectations. We saw a modest drop in earnings estimates right after the Liberation Day announcement, and we've come right back. So I don't think forecasters are really internalized the risks to the economy, because it's really the threshold of what you need to see has gotten a lot higher, because people are getting really tired of betting on a recession. It's like the boy who cried wolf. So that just means, and the Fed's kind of conditioned them for that in a way as well, because they're telling you they want to wait. So it just means that the pain might be a lot higher as a result when the wolf does show up. And to me, that's concerning. I mean, I think it would be really ironic if the Fed is so far behind that they begin cutting rates and the dollar actually strengthens, because everyone's so nervous that they're so far behind, and so they start seeking safety. Anyway, that's neither here nor there, but that's just sort of my 2 cents.
You think there's a possibility they go in July?
I mean, sure, anything's possible, but I think, it's a race between unemployment and inflation. Right now, unemployment is rising more rapidly than inflation is, right? So for May at least, they overestimated how much pass-through there would be from tariffs, and they underestimate how much of a shock there would be to the labor market. So for the time being, it looks like tariffs are largely a contractionary development for the economy, and that's kind of not showing up so much in inflation. Whether that remains the case in July, I mean, they may rationalize not going in July because we see a little bit more tariffs and the unemployment situation hasn't cracked enough. So, I don't think it's necessarily a good setup right here going into the summer.
I mean, I would just point to, without being too overly negative on this, the one thing that I think has to be considered here is you still have industrials as part of the leadership contingent, right? You still have tech as well; it's emerging. It hasn't been that strong. You have utilities as part of the leadership contingent, and I think again that's probably more AI than anything else. But that is something to keep in mind. Discretionary is, albeit at the margin, outperforming staples. So this idea that we're headed headlong into recession, at least from the market's message, would be pretty unique, that the market would be teasing that out through the various industries and sectors. So I think that's still good news. And I would also say the factors. I mean, if we look at the quality factor, those have been under pressure since the lows, and continue to be under pressure. And momentum continues to work. Beta continues to work. Actually, beta is now in the 99th percentile of historic returns. So the market's clearly keyed on something else, and I think that's an important message, that we have to respect what the market's seeing, whatever that might be, in terms of the path forward and the likelihood of that recession. So,
and Jeff, in your survival guide this week, I know you put a good list together of the sort of vulnerable names and high beta, low momentum buckets. So, for people who are interested in that, they can certainly reach out to sales@renmac.com.
Yeah, I think that's the difference. A lot of people confuse beta and momentum, and they're two very different things, right? Beta is kind of volatility around the price action as it relates to the stock market, right? So the stock market's up, say 10%, and this is very simple math. And beta is, your stock beta is 2 to 1. That means your stock's going to be up 20%, right? And vice versa. If it's down 10% for the market, that stock will be down 20%. So it's just kind of the amplitude of the swings. That's what beta is. Momentum is really the price momentum. It's just the rate of change. It has nothing to do with the volatility. It's just how strong that is in terms of the path. And so what you want to be careful of here are names that are very volatile. Those are high beta names that don't have good resounding momentum, because what that really says is that you've had a big beta bounce, but you don't have that underlying trend. You don't have that underlying strength to really sustain it or move forward. Now, some of them will reverse, but we're talking in generalities here. If you look at these beta buckets, we have 200 names in each bucket, right? So we wouldn't expect all 200 to act similarly, but in playing blackjack and seeing the same cards and the same hands over and over again, that's how that's going to work. So be very careful of high beta, low momentum names, because those are most likely just bounces, and those bounces are more likely to fail and become also rans, if not laggards, as we move forward.
And I think you've pointed out too, over time, that at this point in the cycle, the leadership, right? The relative leaderships, those with momentum, are tomorrow's narrative, right?
Yeah. So relative performance, if you think about it, there's just no other way that you're going to have leadership unless that's what I love about relative performance. Relative performance, by definition, you are going to have a look. Now, it's up to you to buy them or not, and to, understand what's happening and what's driving these things. But using relative performance means that you have a look at all of tomorrow's best winners. There's just no other way around it. You can't have Amazon today without it having been a relative strength leader at some point over the last 30 years. That's just the way it has to work, right? So that's what I like about relative strength. It's always giving you an opportunity to see what tomorrow's leaders are, and you just have to be creative enough, or smart enough, if you will, to figure out what that narrative is that's going to drive that stock higher and make it, a 20 bag or a 30 bag or a 100 bag or whatever the case may be.
Have we ever seen a scenario where like some of these cyclical areas have like done well and then just not, you know what I mean?
Like just fall out of bed?
Yeah, like, I mean, because I mean, I might be mistaken, but I feel like industrials were probably doing well in 07.
No, not actually. The only thing that was doing well in 07, going right into it, I just remember it really, really well, was energy. And I was working with a strategist at the time. I will not name names. And he took his S&P forecast up. I think the market was at 1,700. And he took his forecast up in October to like 2,000. This is on the S&P. And I'm like, you're out of your mind. Like, the only thing that's driving the market here is energy. And like, the last thing you want is energy to be the leadership. Like, that's the clarion call of the end of a bull market. He's like, well, earnings estimates, blah, 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 all that same trope that you get from these guys. And obviously that was just a disaster, right? So industrials weren't, I don't recall, frankly, but I don't, nothing was that impressive at the time. It was really more, what we were seeing was energy was the big, clear leadership. So I'd have a hard time believing that while energy's leading, somehow, industrials were right there.
I want to shift gears a little bit, just to talk about stablecoin. I know Howard Mason from our shop here has got a call on Wednesday. It's a series of calls he's doing on AI and payments through stablecoins, agentic web and AI payments. Just today, I think, or yesterday, Walmart and Amazon are exploring their own corporate stablecoins. There's a lot of movement in DC, right, Steve, on that front?
Right. There's going to be a Senate bill on Tuesday, and the House will have to act. I think it's not a question of if, it's just when. And I think that's sort of thing to watch. When is going to be July? It's probably going to be crypto, where you're going to see the stablecoin bill, potentially some other bills move. And I think that's important because, unlike regulation, legislation is more durable. I think one of the things to watch, as you're sort of alluding to, is do we start to see more competition in the stablecoin space? Do banks and others start to juice their own competing products, and what does that look like? And I also believe I heard Treasury Secretary Besson suggest that stablecoins, said this in the hearing the House Ways and Means Committee earlier this week, may create an appetite demand for more treasuries. I know that's something that's clearly top of mind for him. So another thing to watch moving forward.
At a time when Bitcoin continues to move higher, right? I don't even know where it is today. Probably higher. All right, mailbag time. Remind all the folks listening that if you submit a question and we use it, you get a nice RenMac trucker hat, lots of colors and styles. So please put those questions in. Harry, we'll turn it to you, our mailman.
Okay, today our question comes from Pradeep Mara. And the question is the thrust momentum in Chinese equity still valid and consolidating, or is it at risk of fizzling out? Thank you.
I think that one's for me. Is the thrust momentum in Chinese equity still valid and consolidating, or is it at risk of fizzling out? Well, usually those signs, he's referring to the thrust that we had back in the fourth quarter of last year. So we're a good 6-9 months into this now. Usually those thrusts will we'll have more of a momentum return at this point than what we've seen so far. So clearly, it has not, from a timing perspective, been as strong. But escape velocity is escape velocity. We haven't changed trends. In fact, what it has done is really just re-upped the trends, if you will. Now, Hong Kong looks better than China, so neither one of them look bad. But Hong Kong certainly has more of the characteristics there. So I would not say it's negated. Certainly has not fizzled. It's been a little bit more of the testing the patience, but it's still in a trend. It's still a big base. It's still one of the cheapest areas in the world when we compare the valuations, the market cap to GDP. There's a lot of good things there, and the sentiment environment is still relatively robust. In fact, if we look at Chinese tech specifically, the CQQQs is one of the things that we measure. If we look at the ETF flows there, ETF flows just in the last week or so got to the excessive outflow camp, which is good news. That says that people have given up on it. And again, we haven't cracked any important trend levels. We haven't cracked any important support levels there. If anything, it's just really building and continuing to build. So I think it's still there. Be patient with it. I know it's been frustrating. It's a large allocation of portfolios here at RenMac, and we're still there. So good things are likely to happen after you get those thrusts. Usually it's about a 12-month window. Again, you get returns in the next 3-6 months. Those have been flatter than what we'd expect, but that window is usually open for a full 12 months, and I think we're still there.
All right, let's go around the horn. What to watch coming up this week? Steve, we'll start with you. Your face is really red. Your kids are doing dirty work in the back, and you're just, look at you.
What's your blood pressure right now, Mike Chad?
Put some sunscreen on.
Yeah, apparently in these 5 minutes.
This is what Harry Chen looks like after a couple of beers.
Now you look better. Is that shirt for Mercy Hospital? Oh, you in the hospital?
That's our church where our oldest son goes to school.
Now I feel like a jerk.
No, it's okay. Well, look, there are a few things to keep an eye on. I think the situation, obviously, between Israel and Iran is going to have big implications, and I think that's going to spill over into a G7 leaders gathering. It's supposed to begin Sunday, last through Tuesday. Visually looking to that to see some maybe positive movement here on some of the traded tariff front. I think that still might happen, but again, I think those conversations are now going to be primarily focused on the situation in the Middle East, as opposed to maybe just more focused on resolving some of the trade conflicts before. Not that they can't do both. I just think that's important. You mentioned the stable coin bill Tuesday. It's going to be a short week in Congress. So you have the Juneteenth holiday. So the House is out. So it's only until Wednesday. I expect Senate Republicans to try to release the text of the reconciliation bill with the goal of moving it, at least in the Senate, the following week to try to meet that July 4th deadline. Again, that's self-imposed. And so we mentioned maybe crypto month in July. I also think that July is going to spend reconciling the difference between the House and the Senate version, because the Senate will put its imprint on that, and they have to pass the same bill. But I think they're probably still going to do that before the August recess.
Neil?
In terms of the data, I'll be focusing on retail sales and claims. So that'll be important, I think, market relevant information. And obviously, we have the Fed meeting next week. I'm not expecting much. Their dot plot will be released. My expectation is that they leave it unchanged. We'll see how the unemployment rate forecasts change. If they don't sort of acknowledge that the labor markets are cooling a bit more than they thought, I would take that as a negative sign. Powell has been sort of saying repeatedly, the labor market is solid but cooling. Obviously, if something continues to cool, it can't be solid anymore. That's not really how temperature works. So I think if he continues to repeat that, it would be sort of problematic, because it just seems that they're sort of turning a blind eye to the risks with the labor market. So we'll see, but it's going to be a big week, both in terms of the data and Fed policy.
And Jeff, what's on your radar?
Well, we're continuing to watch these real yields, but the most recent kind of development has been the breakout in some of these metals. Obviously, gold's been strong for a while, has been consolidating here recently, but we had a new high in silver, new cycle high in silver. That's through $35 now. The old high is somewhere around 50. We had uranium breakout last week. We had platinum breakout last week. These are all precious metals. Some have more industrial uses than others, but there's a real bull market that's taking place in the physical metals. Now, copper hasn't broken out yet, but it's still a decent chart. What's interesting is there is a disconnect that you see the gold miners, you see some of these precious metal miners. I mean, look, when you dig things out of the ground, you're going to get everything, right? So, even Freeport finds gold. Obviously, there's more copper in their mix, and they're focused on copper. But these miners actually don't look as good as what the physicals do. So when we look at BHP, we look at Freeport, we look at these names, they're really not that interesting from a technical perspective on the equities, but the physical certainly looks far more interesting to us. So there's usually a global dynamic there. And again, I think there's this play between these real rates and the dollar and these precious metals. And frankly, you had EM. The EM markets made a new high last week, right? So good news, and that's going to be good news, obviously, for likely for Hong Kong and China. So, things are still humming along pretty well, even though the data's, maybe a little suspect. But the markets globally, and it's not just a U.S. phenomenon, the markets globally still look pretty decent. I'd say the one that looks more vulnerable, lo and behold, is Japan. But the rest of them still appear to be affirming bull market tendencies and characteristics with higher highs and lower lows.
All right, thanks, guys. I think that does it for us. Be sure to join us again next week when we'll be 1 week older and 1 week wiser, and we'll have another Father's Day under our belt. So that's good news.
What's everyone doing for Father's Day?
I'm knee deep in graduation stuff, so I don't know. That sounds like it's not going to be my day. Never is, but the illusion, is wiped away a little quicker this year than it usually is, I guess.
I'll be at a lacrosse tournament out in Long Island, and then coming back from Long Island to New Jersey.
It's a great way to spend Father's Day. The commute from Long Island back to New Jersey
on a Sunday in the summer. Yeah,
dude, in a helicopter.
Just grilling here with the in-laws and my parents. What about you, Neil?
Well, I'll be doing what Dut's doing. I'll be visiting my folks in Long Island and making my way back to New Jersey on Sunday. So, But I do that every weekend. So
you guys get a helicopter together.
There we go.
Save it.
I don't know. I saw what happened with the helicopter. I'm not going on a helicopter. The Jesus nut flying off. No, thank you. Neil, what do you do with that shirt on the back of your chair there?
Huh?
What do you do with the shirt that's on the back of your chair?
I put it on before the Monday morning call.
Ah, there we go.
His dress-up shirt.
So join us Monday when you'll see Neil in his purple and white check shirt. Don't forget to follow us on Twitter and subscribe to our YouTube channel and reach out to sales@renmac.com for more information if you want to hear what we do on a daily basis. Until next week, I'm Steve Duttenhofer.
I'm Jeff DeGraff.
I'm Neil Dutta.
I'm Steve Babler.
Have a great week, everybody. Happy Father's Day.
Yeah.